Welcome to the Intro to Finance and Quant Ideas workshop. This will be the first in a series of a couple focused around quant finance and different relations to data and other interesting stuff you can do in the area of quantitative finance. So this meeting will cover mostly basic ideas and fundamentals of financial securities. There's not going to be too much like interaction with data tonight. It's mostly going to be focused around setting some foundations for understanding for future meetings. Just wanted to kind of bring people onto a set level so that way no one is struggling to understand stuff later on. And so everyone kind of has a general idea of the type of topics and stuff that will be covered in the future workshops of the series. So we can start with some basics, company basics. So a lot of this will be focused around stocks. So one good thing that's to know is kind of how those work. You have the foundations of a company, which is pretty much the equity, which are assets and debts that a company has. So if a company owns, like say it's an agricultural company and they own a tractor, that would be an asset, it has some value to it. That's on their balance sheet and they have it, it's a thing of value. And there's also debts, which are obligations that they would have to pay out at some point to another party. So this could be like, say they bought that tractor with a credit card. That would be a debt. That would be money they would have to pay back at some future point. And this all comes into shareholders. They own some part of a company's equity. So they own some portion of those assets, some portion of those debts. This is pretty commonly handled through stocks. And then companies' value or their market cap is made up of those shares multiplied by the share price. So if you want a company's value, that's kind of like the market cap. And then each share is a fraction of that company. So say you have like 1,000 shares that are each $1, that company would be worth $1,000. And that share price will fluctuate based off of how much the company is valued. This could be based off of their assets, or depending on where those, how those stocks are handled, it could be based on what people's perception of how much the company should be valued is. This can also be tracked through what's called a capitalization table, or cap table for short, which is often used to track shareholders, especially when you're looking at private companies. Usually when you're going in venture capital stuff, the cap table will be pretty common to use because it's a very easy way to track who owns what amount of the company. Moving on from there, some common shareholder rights. So these are pretty much what each stockholder or shareholder is usually given. These will change based on the company and is usually outlined in somewhere in a company constitution or something, but most often includes the rights to the company's books and records, pretty much their financials and any like disclosures or any other bylaws they have. The SEC also, this one's more so enforced by the SEC than any actual company constitution. But if you're a shareholder of a company, you do have the legal right to sue the corporation if they mislead you in any way, including like misdeeds of their directors and officers. Usually, depending on what type of stock you own, have the right to vote on the company matters, such as their board of directors and so on. Not always, but some companies will offer dividends. These are usually, think of this as sharing like the profits of the company. If a company makes a large profit, they may hand out dividends, which is kind of your share of what the company is making. You also usually, most companies have annual meetings. Now in the age of technology, a lot of these can be handled through online through conference calls. So usually people will, they'll have like an in-person annual meeting, which takes place around the company's headquarters in some hotel or whatever, but they'll also let people join through any other technological way, given how the annual meeting is supposed to take place. And they'll usually discuss matters related to that voting. Usually what happens is that voting is handled at that annual meeting, which kind of ties into the next point, is voting by proxy. If you ever like invested in have like a retirement account or something and got an email from them saying you have the option to select your proxy vote. This is what that's referring to. These go hand in hand with the voting rights. So if someone's not able to make the in-person meeting, usually you can fill out on this proxy form what you would want your vote to be, and then that would all now be handled digitally at the in-person meeting. And then also, if the company goes bankrupt or liquidates in any other way, you are given the right to a certain amount of the assets that are liquidated when the company is bankrupted. This will vary based off of the structure of the company, but usually there's some very small portion of proceeds you would get from the company liquidating. And then to track all of this, most public, or I guess all public companies are required to file SEC filings. These are a variety of different forms that keep the public and also their stockholders up to date with what's going on in the company. This is how most investors keep track of how much money public companies are bringing in and so on. These main statements are their balance sheet, which tracks all their assets and liabilities. Their income statement of revenues and losses, so how much money they're making from operations and how much money they're losing from taxes or anything else. And then cash flow statement is very similar to income statement. I'm not going to go too deep into the difference between those two, but they're pretty linked. They're both dealing with the amount of money they're bringing in and the amount of money that's going out. And then all of these for public companies are public on the SEC website if you'd ever want to go out and look for examples of those. So getting in, our main focus is going to be on publicly held companies, since you can't really easily trade shares of private companies, and it's not from a quant standpoint, there's not much to look at, as that's usually handled over very long periods of time, and you can't really easily assign a value to a private company and trade it with other people. But when we go to public companies, the most common way public companies are handled are through stock exchanges. These are public exchanges where people can trade stocks of companies if they want to. Usually to get on these exchanges, companies will go through what's called an IPO. So this is where they'll initially start selling their shares in a public setting through the exchange. And exchanges are kind of a secondary market. Companies aren't usually directly participating. Usually the IPO is like the initial point of where once a company IPOs, their value isn't so much attached to the stock anymore, so much so as it's attached to what people think the stock is worth. However, there are a few caveats to this. If the company wants to offer more shares, they can do that as a way to cash in on, say, if they think the public thinks their stock is valued more than they think. And then there's also share buybacks, which is a common new method to kind of help out shareholders other than the old way of dividends. This is where the company will buy back shares, and usually this increases the stock price rather than handing out money directly through dividends. And some basics. It's a stock exchange. You bid to buy a stock, you ask to sell a stock, and then the price falls somewhere in between. This is all like now electronic and automatic and happens really quick. So it's hard to kind of see that happening. And there's no like, unless you're like really high up at big financial institutions, you really don't have access to see this happening in real time. You can see the price changing on, say, Robinhood or Google, but that's usually delayed by up to 15 minutes or so. However, these brokers, which interact with the stock exchange, so Robinhood, TD Ameritrade, Fidelity, pretty much these are the people you go to if you want to buy a public company stock, if you're not a big financial institution and can't directly deal with the company or deal directly with the exchanges. You'll go to them to buy and sell your stock. And then the SEC requires these people to get the best price for your order. So you also have market makers, and these are usually where brokers go to help facilitate these trades. So um, as I said, stock trading tends to happen really like fast now. You can't really see like the price change in real time anymore. And that's because of these market makers who buy and sell stock constantly for the brokers to help facilitate, to make sure that those brokers' clients are not left in the dust and waiting like hours upon hours for to buy or sell shares. They provide the most liquidity on the exchanges today, and they make their money by taking buy orders from those brokers and then selling them later down the line when the price adjusts or someone asks to sell their stock at that given price. So this is kind of covering stocks so far, but I do want to mention there's a bunch of other financial instruments you can cover. You have bonds, which are your classic debt instrument. This is how companies will usually, if they want to pay for some big purchases or something, they can sell bonds. They're essentially, you're essentially giving the company a ton of money at the start, and then the company will pay you back over the course of the bond's lifetime. It's kind of like a loan, but handled a bit more structuredly. You also have futures, which trade on the future prices of stocks. So say you think a stock would go up in the future, hence the name future, you'd want to, you could buy these futures. They're pretty complex, so there's a lot you could say about those. There's also warrants and currencies and much, much more, but these are just a few. We won't be focusing too much on those. However, there is one other pretty common instrument that we will be focusing a lot on as well, and these are options. They're a contract to buy or sell a certain amount of shares at a given strike, the price that you would expect it to be on a set expiry date. So if you expected a stock to be, stock's $50 right now, you think it would go to $100, you could buy a contract to buy it for $75, say a week from now. And you have the option to buy as much of that stock as you have set out in your options on or at that given date. There's also the idea of American options and other separate options. All this will cover the details of American options, since those are the most common and what we'll be using. So X is the number of stocks a single options contract is worth for American options is 100. So each contract is for 100 of a given company's shares. And then to buy and sell these options, you have what is called the premium, which is the cost of the contract, commonly shown as divided by 100, because there's 100 different shares that the options contract represents. So if a contract has a premium of 35 cents, this would be 100 times that, so it'd be a $35 premium for that contract. And if you wanted to buy or sell the shares that are represented by that contract, you would still have to pay the price, that strike price that's attached to the option. And then when you're trading these, sometimes the exchanges will handle the exercising or selling for you. But yeah, that's a pretty broad overview of how options work. And later in the series, I'll go more into detail on how these work. But as you can see on the right, this is kind of like an outline of the cost of different options. So you have a call option on the top. So a call option is a contract to buy the certain amount of shares at a given price. So if the strike price is $10 and the premium is $1, as the share goes above $10, the premium in theory should go up in tandem with the price increasing. If the stock ends below $10, the option isn't really worth anything. Usually it's called expiring worthless, because there's no reason to buy a stock for more than it's worth. So you're not profiting off this option if the stock is below that strike price at the end of the expiry date. However, if you wrote the option, that means you were saying that you would sell 100 shares of the stock to the person who bought it. So you want the price to stay below that $10 because that means you get the full amount of that premium price. Because when you're selling it for that premium price. So you want that premium price to stay. You want that stock to stay below $10. So it expires worthless for the option holder, but you get to keep all of the premium that you sold the option for. And then for going back to stocks, there's a bunch of different ways to determine the value of a company and thus the value of stocks. Some common ways are the ratio of the share price to the amount of money the company is making, and other similar ratios. These aren't directly used to value them, but usually what you'll do is use these ratios and compare them to other companies' ratios and find a fair value that way. So kind of valuing it based off of the market. It's called comparable company analysis, or CCA. You also have discounted cash flow models, which is where you're forecasting the future cash that the company will bring in to attach the value to the stock, also called DCF. And you can see the formula for that down there. It looks pretty simple, but it gets pretty complex calculating it due to the way that companies present their information on their financials. So you have their cash flows, and then it's based off of the what's called the risk-free rate, which is essentially how much money a dollar would be worth if you put it in the U.S. Treasury for that amount of time. And then there's also more computational methods of determining value using technical analysis and moving average momentum measures. We're essentially trying to figure out how the public is perceiving the stock and where the stock price will move based off of that. And then you'll end up buying or selling shares based off of those indicators. And then this isn't necessarily too important to the actual quantitative side of stuff, but just to know of like people who participate in kind of this financial system. You have hedge funds, which are big financial institutions who buy and sell stock, usually for more wealthier clients. You have proprietary firms who are kind of like a smaller version of hedge funds. Usually they're operating with a lot less high net worth individuals. You have banking firms, which are your Bank of America, Barclays, your Goldman Sachs, and so on. You have the government, of course. You have Federal Reserve and Treasury who are participating. And then the other big players are pension providers as well. And then getting to the main focus, we have quants and kind of what quants do. Quants will focus on many things, but they're mostly going to be focusing on, their financial modeling roles, in which they're collecting, preparing, analyzing data, and using this data to build up models so they can trade stocks and make money off of them. Roles are usually filled by math, physics, and CS graduates, but of course, BDAA, you can also be a data scientist for this. A lot of the skills are pretty similar. It's a lot of math, and that's where the other majors tend to come in at. Some skills usually held by these positions are pretty strong statistics and calculus and linear algebra backgrounds. Linear algebra, of course, incorporated into the other two, but it's a very math-heavy process. And then a lot of quants will usually work in Python or C++. Usually a lot of the models are written in Python, and then they're moved to C++ because C++ is a faster language and can execute quicker. And the name of the game when you're trading stocks is how fast stuff is moving. And then also occasionally Java and R are used as well. All right, so that's the main meat I wanted to cover during this meeting. And then if you want to look more into any of this stuff, I would highly suggest that looking at some of these articles on Investopedia. So this is kind of like Wikipedia, but for the financial world. So it has a lot of different there's thousands of articles on here of really good information to run through. You can see there's plenty of stuff here. You have a whole investing essentials. There's a lot of here that you can look at, and it's a big world of financial trading. I was also going to cover, so there's different types of quants, so to say. You have the quantitative trader who's usually doing the trading. You have the quantitative researcher who's researching different methods to back financial valuing. You have the financial engineer and quantitative developer who are pretty similar. They're both writing the code to kind of take what the quantitative researcher is doing and use it to make output that the quantitative trader can trade on. Yeah, that's a lot of what I wanted to cover. And then also I wanted to show some other interesting resources to look at as well that probably go more into depth in the next meeting. So there's this site called Quant Connect, which has a lot of resources for quantitative model building. It has a lot of data sources you can use and look through. It has I don't think I can access this because I'm not signed in. Actually, I can. But they have a big forum where people discuss their different trading methods and so on, which is pretty cool to look at and see what other people are doing and how you can utilize that. And then there's also TradingView, which is a bit more, it's a bit easier way to look at the stuff that Quant Connect has, as it's got more, yeah. Wait for this to load. There you go. So it's a bit easier, I would say, to use TradingView because you can look at all the different indicators you can use to look at stocks. We'll cover some of these later on, but these are just a look at how many different ways you can look at stocks, looking at moving averages and different changes in the prices. You have technical indicators, you have fundamental indicators, which are those ratios I was talking about before. A lot of different stuff you can look at when you're doing financial analysis. But yeah, I'll open it up to questions then.
So a question I had was, would quants generally kind of specialize in one kind of security, or would they, or asset, or would they just kind of know it all?
It's a little bit of both. Usually, oftentimes when you're working with banks and stuff, they'll assign you to work on like one sector or another, but most of the skills are pretty transferable between the two. It's more so comes down to what specifically you're building the models on. So dividing up the roles are more so comes to how the different models interact with different sectors more so than any of the transferable skills.
Okay, I see. And then another question I had was, I saw the trader was obviously the person who would actually implement the doing the coding, but what would the researcher do?
Yeah, it's a bit tough to really like conceptually like split the roles. The researcher is mostly looking at there's a lot of deep math you get into when you're looking at quants at big firms and what they do. But researchers are they're going through different. It's kind of what it sounds like, where they're researching different financial studies and so on to see what they can garner out of those. Because the traders usually during the day are going to be busy, like actually on like the floor and trading, so they don't have as much time themselves to work out strategies. So the researcher is kind of offloading a lot of the research that is normally needed to work out all the different strategies.
I see.
Yeah, and if you come up with any questions as well outside of this meeting, feel free to, if you're in the BDA Slack me. I'm sure not too hard to find either with my last name. If find me on anything else as well, but BDA Slack is fine as well.
I have a question just because I'm curious. What's the first stock you bought yourself, and like what made you buy it?
I bought AMD, which makes computer processor chips back in 2018. I was first getting in. That was like when I first like was able to like trade real money, because you can't trade on real money exchanges until you're 18. So I was just getting into it, and it just happened to be the first stock I bought. There wasn't too much thought to it when I was looking at it at that point.
It was just low when you were like, yeah, I want that.
Yeah.
Nice. Do you want to explain the series a little bit more?
Yeah, so this meeting may feel a little bit like shallow in terms of the information, and it was meant to be that way because it was mostly supposed to be a primer for the later series. The next one, I'm going to aim to go more into how you kind of value a stock from a more simpler level, mostly the like ratios and stuff, kind of how to figure out those and how those can be used to attach values to companies. I also want to touch on options as well and go more into those. You may feel like I didn't cover too much in terms of the financial information, but everything in these slides should be enough to understand what should be in the rest of the series.
So are a lot of these like models that they build for trading, do they leverage any use of like artificial intelligence or machine learning, or is that not really a technique which is used that often?
Yeah, some will, some won't. It's not really useful for necessarily figuring out like how much a company is worth or so much, since that's so much, since companies are publicly traded and a lot of the value is based off of how public perceives them. It's pretty much, not pretty much, it's kind of tough to have a machine learning model kind of predict human behavior. But what they are useful for is some other concepts like portfolio allocation. So how much money should you be putting in a certain stock that your model said to buy? That's the main use of it, is in those areas, particularly in that allocation of how much money you should put into a certain stock. Because a lot of that can be modeled out using variance or volatility of the stock, which is much more easier to calculate and much more easier for machine learning models to understand.
Oh, I see.
Yeah, I've been working with some people who have been trying to work on research in terms of putting machine learning models into trading stocks. And it's really tough because, as you can imagine, I mean, even working with time series data for machine learning is tough in itself. But when there's no like, it's not like predicting like supply chains or anything where there's kind of like cycles of people who want to buy a product or something. You're dealing with something that's a bit more kind of erratic and irrational.
Yeah, it's very noisy data.
Yeah.